Hi, welcome to Retiring Well. Folks, we got a great show lined up for you today. We're going to be talking about life settlements. Ever wonder what those are about? How about load fees on mutual funds, those commissions that you're going to pay? What are self-directed IRAs? How about health savings accounts, right? What are they? And 529 plans. Folks, we're going to be talking about all of this today, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, listen, in this segment, I want to talk about life settlements. Now, folks, that's just a technical term for basically somebody selling their life insurance policy. Okay, I was having a conversation with a client not long ago, and it just reminded me that this is a subject I needed to talk about. They had been paying premiums into a whole life contract for a number of years. Okay, they still wanted the death benefit, but the premiums were going up on them. And now they were considering all this money that they'd paid into it and whether they should get rid of it. And I said, have you considered life settlements, selling that contract for cash? And they had not considered that. So I wanted to talk about this. Listen, if you have a life insurance contract, there's three parties involved. There's an owner of the policy, there's the insured, the person that's being insured by the policy, and then there's the beneficiaries. So you can take that life insurance contract and change ownership, okay? And usually if you sell that policy, they're going to turn around then and make themselves the beneficiary. So when you pass away, they of course get the death benefit, and you got the cash that they paid you to buy it out. All right, now all kinds of life insurance this can happen with. There's term insurance, there's whole life, there's universal life, there's variable life. All of these kind of contracts qualify to be contracts that you can sell. Now the amount will vary, how much you get for these contracts, depending on the type, your age, health, but on average, most people, from what I understand, it's about 22% that they can get from these contracts. Now, there's life settlement companies. These are companies that will buy a lot of these contracts. They do it in mass because, they can pool the risk. Sometimes they'll estimate how long somebody's going to live, and they live longer than they want to. Sometimes it's short. So if you pool that risk, it's a little bit more profitable on their end. The one nice thing about this with settlement companies is the principal is guaranteed, right? They know what they're going to receive at the end. It's just a matter of when they're going to receive it. Now, you can sell these contracts to individuals. There's nothing to stop you from taking this and selling it for cash to somebody else. Some people should consider kids. If you're looking to stop paying premiums on a policy and you don't need it anymore, but maybe your kids as a legacy want to keep it, maybe they can take over the payments or ownership, right? I think when you're looking at life insurance, you got to be careful. Don't look back. Don't look at all the money I've paid into it. You need to look at it as it is today. Are the premiums worth paying for the death benefit that I'm going to get? Don't look back at how much you paid it, but look at it going forward. There's also something what they call viatical agreements out there. It's the same thing as life settlements, very similar, except it's usually for people that are terminally ill, maybe gonna, estimated life is going to be maybe 2 to 4 years. Now the difference with viatical settlements is that they have larger payouts because you are going to die sooner, and they're tax-free. So now you'll hear that term used a lot of times too. I think according to Fluent Magazine, Warren Buffett is purchasing $600 million a year annually with these kind of contracts, so they're a viable investment. Folks, they also have low correlation to the market, right? Because they're not going to move with the market up or down. They are what they are. So hopefully you found this valuable. Again, I was talking with a client, just thought maybe you'd want to know about them. Hopefully you do. I want to take this opportunity to thank you for watching this show week after week. Every week we try to give you valuable information that you might want to know and making your retirement vision a reality. Listen, there are some pitfalls out there that you're going to want to know about. I share a number of things with you each week, but there are some that if I had to take 3 or 4, it would be these. And I'm going to share them at this live event. Now, historically, we've always done this, put it together with a dinner at a restaurant. We don't feel comfortable with doing that just just yet. It might be a little bit early for that, but what we are going to do is put this event together in a movie theater, okay? There we can respect each other's social distancing. We can put on the event. I can give you some valuable education that you're going to want to know. So folks, call the number on the screen, visit the website that's also posted on the screen, and sign up for this today. Look forward to seeing you there. Hi, welcome to Chalk Talk. Listen, in this segment, I want to talk to you about load fees in mutual funds. Now, as I show you this, I want you to understand that all load fees are different, but hopefully it'll give you kind of a feel for how these commissions are charged based on the class share you're in. Now, most mutual funds, you'll see, they'll describe the mutual fund, and then following it is like an A, a B, or C. That's the share class or the mutual fund you're in. So knowing this is very important. So out there they have what they call A shares. Okay, now A shares typically have a front load fee. And just as an example, I'll show you that they can be maybe 4 to 5% up front. That means as you put money in the mutual fund, there's a commission or a sales charge being charged right up the front that's coming off it, which is maybe 4 or 5%, for example. Then they have what they call an annual commission, or what they call a 12B1 fee. Typically on these A shares, that might be maybe, a 1/4%. Okay, that's just their annual commission they're going to charge on that share class. But there's usually no backload associated with it, meaning you pay the commission up front, that maybe that 4 or 5%, you have your annual commission, but then forevermore you don't have any commissions other than that 12B1 fee. Now there's what they call B shares. Okay, now B shares are where you pay nothing on the front, there's no front load, okay, but the annual commission or the 12B1 fee might be, let's say for example, 1%. Now again, that can be different, but just as an example, that's what it might be. But then there's what they call a backload, meaning depending on how long you've been in, it could be 4 or 5, 3, 2, maybe 1%. Meaning once you get to a certain period of time, let's say 5 years, then there's no longer associated with it a backload. But you now have an annual commission coming off, which is still maybe 1%. Now, there's what they also call C shares. Now, where you have a C share, there's nothing up front, okay? There's nothing on the back, but there's maybe an annual commission, again, of maybe 1%. Now, some might say, why wouldn't I do a C share over a B share? Because I got no backload. Well, understand that most people that go into C shares, they're in it for just temporary reasons, okay? And so they just want to be in the account and out, and so they don't mind just a commission being charged while they're in of the 1%. But they don't want to see a front load, back load. Now, an account like that is going to have much more in cash because people are coming in and out of it, might not perform as well as an A or B because it's not fully invested. Now, for retirement accounts, most people want to do A because they're in it for a long period of time. They don't mind paying this up front on the deposit, but forevermore just pay 1/4%. So hopefully this kind of gives you a feel for these class shares and how they charge commissions. If you want to understand your portfolio and want to know what your share class you have, then give us a call.
Really good information that Larry shared there, and on the topic of life settlements, it brings to attention life insurance. And a lot of times when we're talking to folks that are close to or in retirement, they give an opinion of, well, I'm at that stage of life, I no longer need life insurance. And so that's one of those where that may be the case in certain scenarios, but a lot of times we can use different life insurance planning strategies, whether that's from a tax planning perspective, or there's certain policies that offer an accelerated death benefit rider that would help provide some income for you to help pay for long-term care. So again, life insurance from our perspective is just another planning tool that can be looked at any stage of your life. And the other topic, Nick, that I know Larry was able to dive into was the costs of mutual funds. And that's something, it's a for-profit business, so there's costs no matter where you look, right?
Oh yeah, absolutely. And that's something that a lot of advisors just don't want to talk about, is what the fees are associated with those products. And that's contrary to us, I mean, we're very transparent with our fees. We're going to let you know right up front what those fees are. But back to mutual funds, a lot of people, they understand there's some fees associated with them, but they don't realize there's a lot of hidden costs associated with those mutual funds as well. And that's something where here at Centennial Wealth, we can actually get behind those different funds that you have and show you what you're actually paying and what those funds are costing you on an annual basis.
Yeah, so true. And so if you're in a situation where you're not quite sure maybe what your fees are within your plan, and that's something that's important to you to know, especially when it comes to your retirement planning, we'd be happy to sit down with you, offer a second opinion, and just dive behind the scenes to show you here's what the costs are, and also maybe understand a little bit better what the risk is maybe that you're taking within your portfolio. All important areas to consider in your retirement planning. And stay tuned as we're going to be diving into self-directed IRAs and health savings account next.
In this segment, I want to talk about what's called self-directed IRAs. Now, if you didn't know this, you can actually hold real estate in an IRA. Okay, it could be commercial property, it might be residential property, it could be rental property, it could be raw land for that matter, but you can hold real estate in an IRA. Some other things that you can hold in a self-directed IRA are precious metals, gold, silver. How about cryptocurrencies? Okay, so a lot of people think that their IRAs just have to have, what we call typical mutual funds and the like, but actually can hold these kind of assets in them. Now, other accounts can have these kind of assets in them too. It's not just IRAs. Roth IRAs, SEP IRAs, simple IRAs, even 401ks can hold some of these assets. So knowing that might be valuable to you. Now, there's some rules that are associated with these self-directed IRAs, though, that you have to be aware of. First of all, the investments you put in them, it has to be what they call has to be an arm's length transaction. And all that simply means is that you can't have any personal benefit. So you say, Larry, what do you mean by personal benefit? Well, for example, let's say I put some vacation property, in that self-directed IRA. I can't have any personal use of that property whatsoever. Absolutely none. Let's say that I'm providing the management for that property. Let's say I'm mowing the lawn. I can't take any personal pay from that IRA either. Okay, so I can't have any personal benefit in that real estate from a pay standpoint or use standpoint. Now, if I got, let's say, rental property or vacation property in this self-directed IRA, all income and expenses have to be kept within that IRA. So rent income has to go in there, and then property taxes, insurance that get paid have to go out of there. So all income expenses have to stay in, and no personal benefit can come back to yourself. Now, if you want to do a self-directed IRA with real estate, you got to be careful because you can't have what's called any recourse debt. I mean, you can go out and get a loan with the bank to put it in, but the bank can't go after that property as collateral. It has to be what's called a non-recourse loan. So that's kind of a unique thing. A lot of times it's probably best if you can do these properties with cash. Now, do you have to have a third-party custodian? I know years ago one of the bank trust departments would be a custodian for these self-directed IRAs. I know now online you can Google for them. They've got these companies that act as a third-party custodians for these. Basically, they hold the title of the asset in the IRA for you. So hopefully it kind of lets you know kind of what those are about. A lot of people don't know they're out there, but if you're somebody that wants to get involved in real estate and you're in an IRA and you don't like what's going on with the market, then give us a call. We'll kind of show you how to get set up in one of those things accordingly. I want to take this opportunity to thank you for watching this show week after week. You know, every week we try to give you valuable information that you might want to know and making your retirement vision a reality. Listen, there are some pitfalls out there that you're going to want to know about. You know, I share a number of things with you each week, but there are some that if I had to take 3 or 4, it would be these. And I'm going to share them at this live event. Now, historically, we've always done this, put it together with a dinner at a restaurant. We don't feel comfortable with doing that just yet. It might be a little bit early for that, but what we are going to do is put this event together in a movie theater. Okay, there we can respect each other's social distancing. We can put on the event. I can give you some valuable education that you're going to want to know. So, folks, call the number on the screen, visit the website that's also posted on the screen, and sign up for this today. Look forward to seeing you there. Hi. Listen, in this segment, I want to talk to you about health savings accounts, or what we call HSAs. Now, normally, if you want to deduct your medical expenses, they have to be over 7.5% of your adjusted gross income. Okay, that's the first hurdle you got to get over. And then you've got to take those that are over 7.5%, put them on Schedule A, and then try to itemize your deductions. Now, that's where you can take your mortgage interest, your taxes, and charity, and that kind of stuff. So all those items have to then, if you're single, get over the standard deduction amount, which is $12,400. Now, that's for 2020. Now, if you're a couple, that's now $24,800. So think about it. For most people, it's awful hard for them to deduct any out-of-pocket medical expenses. So that's where these health savings accounts come in. All right. Now, they're accounts that you can put money into. You get a tax deduction for it. It grows tax deferred, and then if you use it for medical costs, those out-of-pocket medical costs, they're not taxable to you. So it can be a great savings instrument if you want to save for those future medical costs. Now, an HSA has to, to qualify for it, you have to be part of a high deductible medical plan. All right, that means that, by definition for a single person, that means the deductible has to be over $1,400. Now, this is for 2020. And if you're a couple, it has to be over $2,800. Now, the expenses that qualify for an HSA are very similar to the same, as a general rule, the same as the ones you take for your medical costs if you're going to try to itemize. Now, if you have an HSA, there's no required minimum distributions, unlike an IRA. Remember, by the time you reach age 72, you have to start taking them out. With an HSA, that's not the case. Now, there's some drawbacks to an HSA you want to be careful of, because if you put into them, get a deduction, and then use it for any other reason other than medical before the age of 65, you can be looking at a 20% penalty. So it's definitely an account you want to be putting money away for medical purposes. Now, another drawback to an HSA is you can pass it on to your spouse tax-free if you have any unspent monies, but beyond the spouse, if you pass it on to heirs beyond that, unfortunately, it's going to have to be taxed. Now, when you put money into an HSA in any one year, if you don't use the money for medical expenses, you can roll it over to the next year. So if you're healthy and you're trying to save for those future medical costs, great way to kind of start building that up. Now, you can have an employer pre-tax plan, just like any 401k and the like, where the employer could be putting away for you, or you can have an after-tax program where you do it with your own dollars and then you can get a deduction. Now, the deduction in 2020 for a single person is you can put $3,550 into it. For a couple, $7,100. And if you're over the age of 55, you can put an additional $1,000. So hopefully you find this valuable. If you're somebody that's interested in putting into one of these accounts, give us a call.
Always good information that Larry shares, and when he's on the topic of the self-directed IRAs, one of the things that came to my mind is the ability with a 401k rollover. It's very common when people retire from their career and they were contributing into, say, a 401k or 403b, 457, what have you. They like to roll those funds over to an IRA because then it opens up their different investment options. And a lot of times people aren't aware that with a 401k, you may have the ability to do what's called an in-service rollover, where you're still working, still contributing to a plan, but you may want to take a portion of that money and move it over to an IRA that'll then open up your different investment options. So again, maybe something worth considering when looking at your 401k, and you would just simply call your 401k provider and ask, you know, do I have the ability to do an in-service rollover? Now, the other topic, Nick, that Larry was diving into are health savings accounts, and I know there's a lot of information around those, so I'll let you share a bit.
Oh, yeah. Yeah, I mean, I absolutely just love health savings accounts. I mean, for a couple reasons. One, the tax-free growth, right? I mean, as long as you're using those HSA funds for qualified medical expenses, you don't have to pay taxes on those funds. But another great aspect of those HSA accounts, as far as our financial planning tools go, they're a great income planning tool. I had a client, or a couple last year, who we signed them up for an HSA eligible health plan through the marketplace or healthcare.gov, and we based their income on $68,000 a year, which is the top of the subsidy limit to qualify for that subsidy. And they were pretty confident with that income, but come the end of the year, they actually had a decent bonus where that bonus pushed them over that income threshold. So what we did was, well, they hadn't contributed to an HSA at that point, so we maxed out that contribution of $7,000 because they were over the age of 50, reduced their income, and they didn't have to pay Uncle Sam that subsidy back. So it worked out great.
Definitely a valuable planning tool and something you may want to consider. If you have questions about that, you're welcome to give us a call. And stay tuned, as we're going to be diving into 529 plans next.
I want to take this opportunity to thank you for watching this show week after week. You know, every week we try to give you valuable information that you might want to know and making your retirement vision a reality. Listen, there are some pitfalls out there that you're going to want to know about. You know, I share a number of things with you each week, but there are some that if I had to take 3 or 4, it would be these. And I'm going to share them at this live event. Now, historically, we've always done this, put it together with a dinner at a restaurant. We don't feel comfortable with doing that just yet. It might be a little bit early for that, but what we are going to do is put this event together in a movie theater. Okay, there we can respect each other's social distancing. We can put on the event. I can give you some valuable education that you're going to want to know. So folks, call the number on the screen, visit the website that's also posted on the screen, and sign up for this today. Look forward to seeing you there. Hi, in this segment I want to talk about 529 plans. Now these are accounts that parents and grandparents can put money into, okay, with after-tax dollars. Now for the state of Michigan, I think they allow you a deduction for MESP, but it's money you can put into an account that's called a 529 plan. It grows tax deferred, and then if it's used for education, then none of it is taxable. Now, just about every state has some version of this 529 plan. I know some of the universities will have their own 529 plans too. Now, 529, you know how it gets that name? It's just the IRS tax code that created these kind of plans. Now, mutual funds, just about every mutual fund company out there will have these 529s that you could do with them also. So there's a myriad of them out there that you can participate in. And again, they're like a Roth IRA in the sense that you're putting in with after-tax dollars, they grow tax deferred, and then if they're used for the proper purpose, then it's going to be tax-free. Now, what are educational costs that it can be used for? Well, for any university, room and board, okay, the actual tuition, their books, basically any educational costs they have for that education. Now, 529 plans allow for any tuition from K to 12. Okay, so you can use it for that as well. Now, the state of Michigan has 2 plans. They have one called the Michigan Education Savings Plan, MESP. Now, that one looks like mostly others. You're putting money in, and it'll have, you know, some counts that you can choose from, conservative, moderate risk, and basically you put into them, and then those funds basically manage that money going forward. And what you're hoping is that they grow to enough to be able to cover those costs when the time comes that you need them. All right. Now, they're subject to market risk, which is in college education, university costs have been rising at, very dramatic rates of recent years. So, the growth on these, unless they're totally aggressive in the market, is having a hard time keeping up with those college costs as they're increasing. The one I really like is called Michigan Education Trust. Now, this one is more of a prepaid tuition plan. You literally pay for the costs ahead of time. But the nice thing about them is it doesn't matter how the college costs rise, you're basically guaranteeing that education is going to be paid for. So I can pay for it today, 2 years at the university or 2 years at community college at today's rates for what it's going to cost me down the road. So I really like those. Now, for these 529 plans, you got to be careful. If the kids have them in their name, they can be, for FAFSA reasons, financial aid, 20% of it can be considered their assets. But if you leave it in the parent's name, only 5.64% is considered assets for FAFSA. Now, grandparents can put into these 529 plans, and that's not a bad idea. Not usually good in the first couple years, but in the last couple years of their education can be very advantageous. So if you're somebody that's trying to save for college and maybe want some help trying to figure out which plan might be good for you, give us a call. We'd be glad to help.
I'm really glad Larry spent some time talking about 529 plans, as I know that can be a valuable planning tool for you as either a parent or maybe as a grandparent. And I know over the years I've been with Centennial Wealth Advisory now 16 years, and several years ago we had opened an office in Petoskey, and not long after that Gaylord, and now that's where Nick, you come in. You're Gaylord resident.
Yeah, so I call Gaylord my home base. I'm in the office there full-time now, and our office is located right on Main Street, just right next to that pavilion there, right on Main Street. We also have an office up in Petoskey. I'm usually up there once or twice a week, depending on what's going on, but flexible, very flexible. So if we need to make a special meeting or something like that, I can get up there. But yeah, the Gaylord office is really taken off, and it's awesome.
And it seems like, Nick, every time I go to Gaylord, it seems like it's expanding, and so it really seems to be growing a lot.
Oh yeah, absolutely.
Yeah, and so that's where, if you're in that area, Gaylord, Petoskey, or even further north, I know we've had some folks that have come over the bridge. That's something we'd be more than happy to sit down with you and talk with you about your retirement planning. I mean, Nick, is that primarily you're sitting down with folks and just having a casual conversation,
I
right?
mean, it's just a quick conversation, purely informational, that first meeting. I encourage lots of questions and no pressure to make any kind of decisions whatsoever.
Yeah, that's so true. I mean, that's something that in any of our offices, our approach is very laid back, and we just want to understand where you are, what you're trying to accomplish, and ultimately then see if there's ways that we can help you plan to retire well. And so if you're in a position where you're approaching retirement, or maybe you're already in retirement and you'd want that second opinion, whether that's meeting with Nick in Gaylord or Petoskey, or with myself or Art or Larry in Traverse City, or Jack in Cadillac, we'd love that opportunity just to sit down, have a casual conversation with you. Again, no cost, no obligation, and just see if what we do might be a fit for your retirement planning needs. So stay tuned. Next week, we're going to be talking about precious metals, so you won't want to miss that show. Thanks again for tuning in to Retiring Well.